biggest IPO in human history is about to print. And history says that's exactly when you should be most careful. On May 20th, SpaceX filed S1 with the SEC. You know what the S1 is, right? Targeted a valuation of roughly $1.75 to $2 trillion and a raise of more than $75 billion. Okay, that would make it the largest initial public offering in human history. Right now, almost every finance video on YouTube is asking the same question. How do I buy this? I want to tell you up front that it's the wrong question. I'm Samuel, MBA IRS enroll agent, formerly with PwC, EY, and I spent years on the institutional side, helping companies and so on in the area of taxation, consulting there. The question I want to walk you through today is one I would have brought to any IPO readiness meeting at any firm. Not how to buy, but why now and at this price. The promise by the end of this video, you will have 3 specific numbers to look up in any S1, including SpaceX's, before you ever click buy. If you ignore those numbers, the IPO process is engineered to make you the exit liquidity. Let me show you exactly why. Once again, make sure to like, share, subscribe, comment if you have any questions. All right. So the mechanism, who an IPO is really for. Okay, that's what we're going to discuss right now. Here's the part that nobody on TikTok or YouTube wants to say out loud. An IPO is not primarily an investment opportunity for you. Okay, it's a financing event for the company and a liquidity event for the people who already own it. Every party in the room, the underwriting bankers, the founders, the early venture investors, the long vested employees, has the same incentive. They want the day one price as high as possible. The only person who would prefer a lower price is the day one retail buyer. And that buyer is not in the room, right? So 3 structural mechanisms manufacture day one demand, right? You have to understand all 3. First, the float. In a typical IPO, only 10 to 20% of total shares are actually sold to the public on day one. The rest stays with insiders. That manufactured scarcity combined with marketing campaigns of first chance to own SpaceX is what creates the headlines, right? The headline calls it demand. Okay. From a desk perspective, it is restricted supply. Second, lockups. Most insider shares are contractually locked from selling for 90 to 180 days. That's 3 to 6 months post IPO. The supply you see on day one is artificially restricted. When lockups expire, you frequently get a wave of insider selling that knocks the price down. And from a family office desk, that is the trade, right? They plan for, not the one we get caught in. Third, and most importantly, index inclusion, right? Once SpaceX clears the size and liquidity threshold to be added to the S&P 500 or the NASDAQ 100, every passive index fund in the world is contractually required to buy at whatever the market is asking. That is not market demand. That is mechanical forced buying, and it lets early holders sell into a wall of price insensitive money. So now let's talk about this. CNBC reported about Elon Musk is expected to retain roughly 85% of SpaceX's equity post IPO, right? CNBC S1 live updates. That number alone, 85% insider control after the largest float in history, tells you who this deal is structured for. 3 case studies that prove the pattern. This isn't theory. The historical record on mega IPOs is one of the most consistent patterns in financial markets. When the single largest deal of a cycle, right, prices, the cycle is usually closer to its end than its beginning. So let's give you 3 examples of that. In May 2020, May 2011. Okay, Glencore, the largest IPO in London's history at the time. Glencore priced at the peak of the post-2008 commodity supercycle. Within roughly 5 years, the stock had fallen approximately 80%. The IPO did not cause the commodity buzz, but the bankers and the insider sellers understood the cycle better than anyone, and they timed the float to extract maximum value before commodities rolled over. The day one retail buyers got the top, they bought the top. Let's look at Alibaba in September 2014. Okay, the largest IPO of its era, raising 25 billion. It popped 38% on day one. Then for years, the stock traded essentially sideways while the broader S&P 500 made new highs. Anyone who bought Alibaba at IPO and held sat on essentially dead money for the better part of the decade. Same pattern. The seller knew the cycle better than the buyer. Saudi Aramco, December 2019, the largest IPO ever at the time, at 25.6 billion, priced at the top of the late 2010 oil cycle. 3 months later, COVID arrived and oil briefly traded negative. The Saudi government knew exactly when to sell. Day one buyers absorbed the missed timing. The common thread is not the company was bad. Glencore is a real business. Alibaba is a real business. Aramco is the most profitable company in human history. The thread is this: when sellers can pick the moment, they pick it for themselves. That's the nature of human beings, not for the buyer. And the very biggest IPOs only happen when the seller is most confident the price is at or near peak. They are, by construction, top of cycle events. CNBC ran a piece on May 22nd, right? A few days ago, noted that the SpaceX float combined with the OpenAI float that bankers are quietly prepared is exactly the pattern analysts watch for as a market top signal. CNBC mega-IPOs signal top. Okay? 2 mega-IPOs from the 2 most hyped private companies on the planet in the same quarter after a multi-year AI-driven equity round. That is a structural top signal. Even if SpaceX itself is a great company. The big four authority moment that I want to talk about is when I worked at EY and later at PwC, right? And we heard about these things happening, right? We were always ready, right? Readiness side was audit and advisory work for companies preparing to go public, right? I want to share something that I learned in those rooms that you will not hear from YouTube channels, okay? The decision to go public is almost never made when the company is at its weakest. The decision to go public is made the quarter, right? Is made the quarter the bankers walk in and tells the founder, right now, today, we can get you the best price you will ever see. That conversation happens in a very specific kind of market, one with high multiples, easy money, and retail enthusiasm. It is almost by the definition a top of cycle conversation. So every IPO, right, that I've seen was timed by people who had looked at the same multi-decade pattern. Okay. They picked moments, they picked them well. And the public buyer almost never realized how carefully the moment had been chosen on the other side of the table. Here is your 3-number framework. Before you buy a single share of SpaceX or any IPO ever, hold the S1 or the prospectus and check 3 numbers. Number 1, free float. Okay. As percentage of total shares. If less than 20% of the company is actually floating on day one, you are buying a manufactured scarcity story. Number 2, the implied valuation multiple relative to its peer set. What is the revenue multiple? What is the price to scale to sales? If it is more than 2 times the sector median, you are paying for a story, not a business. Number 3, the lockup expiry date. Okay. When does insider supply hit the open market? Mark that date on your calendar. Historically, the post lockup window, not day one, is the cleaner entry on every mega IPO of the last 15 years. For SpaceX specifically, wait for the S1/A with final price. Do not buy pre-IPO SPVs at the inflated retail market markups. You are seeing, right? You're seeing this week. If you decide you must own this company long term, the post-lockup window, late 2026 into early 2027, has historically been the more rational entry on deals of this size. To be clear, I'm not telling you SpaceX is a bad company. This is not financial, legal, or tax advice. Musk has built something extraordinary, and the long-term thesis on space economics may turn out to be one of the traits of our generation. I am telling you that buying a great company at the wrong moment in its life is still a bad trade. The IPO is structured for the seller. Your job is to know that and to wait for the moment that is structured for the buyer. Subscribe if you want the post-IPO debrief, cover the first 30 trading days and whether the lockup expiry trade actually sets up. Okay. So once again, I'm Sam. Thank you for tuning in. Make sure to like, share, subscribe, comment if you have any questions. All right. I want to see your whatever questions you have. All right. Take care.